Assalamualaikum warahmatullahi wabarakatuh. Shalom Om Swastiastu, Namo Buddhaya, Salam Kebajikan. Good morning, evening, or afternoon, everyone, wherever you are. Allow us to introduce ourselves. My name is Nathan, and in this presentation, I'm not alone. I'm with Akmal, Novira, and Vanissa. We are from Group 2, and today we would like to present about our presentation about linking corporate and financial strategy. So these are several learning objectives from this presentation. First, distinguish business risk and financial risk. Second, explain the different elements of financial strategy. Third, assess how risky a particular business is. Fourth, understand the 7 drivers of value and how they can be related to business strategy. And the last is discuss how the elements of financial strategy might apply differently to public and privately owned companies. Okay, for the first learning objective, I would like to present about the difference between financial risk and business risk. Business risk was defined as representing the risk to the company's operating result. Financial risk is the risk inherent in the company's choice of financial structure. So from this juncture, it is worth considering the key decisions to be made in determining a financial strategy and the associated risk. Financial risk and business risk are two different types of warning signs that investors must investigate when considering making an investment. There should be an inverse relationship between them because financial risk refers to a company's ability to manage its debt and financial leverage, while business risk refers to the company's ability to generate sufficient revenue to cover its operational expenses. Okay, for the next slide, or the second learning objective, is about 4 key elements to financial strategy. There are 4 key elements to financial strategy, including first, acquiring capital to implement strategies. It's about successful strategy implementation often requires additional capital besides net profit from operation and the sale of assets. Two basic sources of capital for an organization are debt and equity. Determining an appropriate mix of debt and equity in a firm's capital structure can be vital to successful strategy implementation. And then theoretically, an enterprise should have enough debt in its capital structure to boost its return on investment. But too much debt in the capital structure of an organization can endanger stakeholders' return and jeopardize company survival. The second element of financial is projected financial statements or budgets. Projected financial statement analysis is a key to implement financial strategy because it allows an organization to examine the expected results of various actions and approaches. A financial budget is also a document that details how funds will be obtained and spent for a specified period of time. Fundamentally, financial budgeting is a method for specifying what must be done to complete strategy implementation successfully. Financial budgets can be viewed as the planned allocation of a firm's resources based on forecasts of the future. Third, about management or usage of funds. Plans and policies for the usage of funds deal with investment or asset mix decision that is which asset to be purchased and which to dispose of. And then there are some key decisions included. These are investment, fixed asset acquisition, current assets, loans and advances, dividend decisions, and the last is relationship with shareholders. Usage of funds is important since it relates to the efficiency and effectiveness of research. utilization in the process of strategy implementation. And fourth, or the last, is evaluating the worth of a business. Evaluating the worth of business is also important financial strategy implementation because company may acquire another firm under diversification or divest under return strategy. Thousands of transactions occur each year in which businesses are bought or sold in the United States. In all these cases, it is necessary to establish the financial worth or cash value of a business to successfully implement strategies. Okay, that's all for me. Now let's move on to the next learning objective, which will be explained by Vanissa.
Okay, thank you, Nathan. So, risk analysis is needed in all organizations, regardless of them being small or large scale, profit or non-profit oriented. Management must be able to manage risk optimally in order to achieve its purpose. According to Otoritas Jasa Keuangan, risk management can be identified as a set of methodologies and procedures used to identify, measure, monitor, and control the risk arising from all business activities. Business activities are carried out by cooperatives that have a savings and loan business, namely raising funds from members and channeling them back to members in the form of loans. Next is the importance of risk management. First, it empowers a business with the necessary tools so that it can adequately identify and deal with potential risks. Once a risk has been identified, it is then easy to mitigate it. Second, risk management provides a business with a basis upon which it can undertake sound decision making. Third, for business, assessment and management of risk are the best way to prepare for eventualities that may come in the way of progress and growth. When a business evaluates its plans for handling potential threats and then develops structures to address them, it improves its odds of becoming a successful entity. And the fourth, progressive risk management ensures risks of high priority are dealt with as aggressively as possible. Moreover, the management will have the necessary information that they can use to make informed decisions and ensure that the business remains profitable. Next is the how to measure the risk. There are three ways to measure the risk. First is earning at risk is the amount of change in net income due to changes in interest rate over a specified period. It helps investors and risk professionals understand the impact that a change in interest rate can make on a company's financial position and cash flows. The second, value at risk, measure the overall change in value over a specified period within a certain degree of confidence. The value at risk model measures the amount of maximum potential loss over a specified period. VAR is always calculated with a confidence interval to represent the confidence of loss. And the third, economic of value of equity is primarily used in banking and measures the amount that a bank's total capital may change due to interest rate fluctuations. This is a long-term economic measure used to assess the degree of exposure to interest rate risk. This value is used as an estimate of total capital when evaluating the sensitivity of total capital to fluctuation in interest rates. So that's all from me. So let's move on to the next learning objective is the 7 drivers of value, which will be explained by Novira.
Okay, thank you, Vanessa. So, the term value driver is coined for those economic variables that are critical to revenue and cost function of a firm. The organizational aim is to create shareholder value. This is done by selecting a business strategy that it is believed will be successful, and that business strategy is derived from analysis of external forces, for example, using the Porter model and the Pastel analysis, and of the company's internal resources and capabilities are framed. However, The strategy so determined should link to what is seen to drive value in the business, using the 7 drivers of value. The strategy developed by internal and external analysis should also reflect the relative worth of the 7 value drivers. If this is done, and if the appropriate performance measures design, with targets that are stretching but achievable, value should be created. Next slide. The 7 value drivers discussed by Alfred Rappaport III are: the first, increase sales growth. Second, increase operating profit margin. Third, reduce cash tax rate. The sales growth rate, the rate of profit margin, and the cash tax rate are used to determine the net cash inflow of a firm. Fourth, reduce incremental investment in capital expenditure. Fifth, reduce investment in working capital. Fixed and working capital increments added with replacement of fixed cost of investment form the total cost of investment. The difference between the net cash inflows and cost of investment gives the free cash flow of a company. Sixth, increase time period of competitive advantage. And the last one is reduce cost of capital. A defined planning period and an appropriate discount rate are also required to compute the net benefit. By adding the market value of temporary investments, the value of the firm will be obtained. Finally, the value of shareholders can be found by deducting the market value of external financing from the total value of the firm. The drivers are not all to be treated equally in different businesses. Different drivers will be more important. Managing financial strategy can enhance the value of a company, but financial strategy on its own is not a key driver of value for most businesses. For the purpose of firm's valuation, it's very essential to identify the key drivers of value because these drivers can either increase or decrease the value depending upon the tendencies of their changes. Several studies, both quantitative and qualitative, have investigated the drivers influencing firm value to have a better understanding of these drivers. They stated that since return on investment, return on equity, and earnings per share figures can be manipulated by management. Therefore, these variables fail to sufficiently measure a firm's performance. So I think that's all from me. Now let's move on to the differences of financial strategy elements between private and public companies, which will be explained by Akmal.
Okay, thank you, Novira. Moving on to the next slide. As we know, normally the business risk reduces over time as the company's core business matures or it diversifies into other areas, and therefore the financial risk should be correspondingly increased. So the first one, high business risk companies should use low risk financing and should keep their cost basis as variable and discretionary as possible. Such as could be achieved by making an equity rights issue and using the funds raised to repay some of the outstanding debt of the company. When it comes to corporate takeover bid, they alter their financial strategies by dramatically increasing the financial risk profile by raising the debt to equity ratio, thus which would enable the company to service and repay the dramatically increased borrowing. So what differs to a private company? In a private company, the directors are often the owners. It means the directors can ask the shareholder directly what they want from the company. Shareholders in private companies may be reluctant to take on any debt if it means they could lose sleep over it. And as private companies cannot suffer the trade of a hostile takeover, there is no need for them to follow the prescribed strategy of gearing up a low-risk business. So maybe moving on to the next slide. So it remarks the end of our focus of our presentation today. We sincerely appreciate this opportunity that we have this opportunity to present to you in this time. If anyone has any question, please feel free to ask through the comment box below, and we'll do our best to answer. For further reading on this topic, we refer to Corporate Financial Strategy by Ruth Bender and Kate Ward. And so thank you and see you again.